Have you ever noticed that most nonprofit leaders spend most of their time focused on protecting the people that they serve, but very little time thinking about how to protect the organization itself? And honestly, I understand why. When you're running a nonprofit, your focus is the mission. You're focused on fundraising, serving your community, supporting your staff, recruiting volunteers, trying to make every dollar count. Insurance usually ends up on the bottom of your priority list until something happens. And unfortunately, that's when a lot of organizations discover that they didn't have the protection that they thought they did. Today, I want to walk through 7 insurance mistakes that we see nonprofits make every single day. These are mistakes that can put donor trust, years of hard work, and sometimes the entire mission at risk. Let's jump right in. Mistake number 1, assuming that general liability insurance is a catch-all coverage. This is probably the biggest misconception I see. A nonprofit purchases general liability coverage and checks the insurance box. Problem solved. Or at least that's what they think. General liability is important, don't get me wrong. It helps protect your organization if someone is injured on your premises. It can help if your organization accidentally causes property damage. It can help with certain advertising injury claims. Those are all important protections. But here's what it does not cover. It typically doesn't cover allegations against board members. It doesn't cover any employment-related claims. It doesn't cover cyber attacks, nor does it cover employee theft. And it certainly doesn't cover any professional mistakes made while delivering your services. Let me give you an example. Imagine someone slips and falls in your office. General liability insurance may help with that. Now, imagine if a former employee claims that they were wrongfully terminated. Different claim, different exposure, different coverage. Many nonprofits wrongly assume that one policy handles everything. And the reality is it doesn't. And finding out after a lawsuit is a very expensive lesson. Mistake number 2, not having directors and officers insurance coverage. If I could wave a magic wand and add one coverage to many nonprofits, this would be top of the list. Directors and officers coverage, often called D&O, protects the leadership of the organization. And yes, that includes volunteer board members. Many board members join because they deeply care about the nonprofit's mission. What they don't realize is that they can be personally named in a lawsuit. Imagine a donor alleges that funds were misappropriated. Imagine a former employee claims discrimination. Imagine a dispute of governance decisions. Even if those allegations are completely untrue, defending that in a court of law can be expensive. And the legal costs start way before anybody determines who's right and wrong. D&O coverage helps to provide a financial defense when leadership decisions are challenged. Without it, board members could be forced to defend themselves. That's not a conversation that most nonprofits want to have with their volunteers. Mistake number 3, uninsuring property. This issue has become way more common over the last few years. Construction costs have increased, building materials cost more, labor costs more, technology costs more. Pretty much everything costs more. Yet, many nonprofits still have property values based on numbers from years ago. Maybe the building was insured for $1 million. Today, that same building might cost $1.5 million or more. And that's a problem. And it's not just buildings. Think about computers, servers, audio-visual equipment, security systems, furniture, specialized equipment, and even vehicles. Many organizations just don't realize how much value they accumulate over time until they're trying to replace it after a fire, a theft, a storm. A good coverage review should account for today's value, not what it cost to purchase 5 years ago. Mistake number 4. Ignoring cyber risks. Some nonprofit leaders hear cyber and immediately think, no one wants our data. Unfortunately, cyber criminals disagree. Nonprofits are attractive targets. Why? Because many organizations store valuable information. Donor databases, credit card information, volunteer records, employee information, financial records, sometimes even healthcare information, depending on the services provided. And many nonprofits just don't have IT departments protecting that valuable information. Cyber attacks aren't just happening to large corporations. Small and mid-sized companies are being targeted too. Imagine coming into work on a Monday morning, opening up your computer, and seeing a ransomware message demanding payment in order to access your data. Now, imagine losing access to your donor information during the biggest fundraising campaign of the year. That can be devastating. Cyber insurance can help with recovery costs, forensic analysis, legal expenses, notification requirements, and other expenses following the data breach. The question isn't whether you're a technology organization. The question is whether or not your organization uses technology. And if you're watching this video, the answer is probably yes. Mistake number 5, volunteer misclassification. Volunteers are the lifeblood of many nonprofit organizations, but volunteers can create a unique insurance challenge. Many organizations wrongly assume that volunteers are covered under every policy. That's not always the case. For example, what happens if a volunteer causes an accident while driving their personal vehicle on behalf of the organization? What happens if a volunteer injures somebody during an event? What happens if a volunteer gets injured while helping the organization? These situations can become complicated quickly. Every nonprofit uses volunteers differently, which means every nonprofit should understand how their insurance responds to volunteer-related claims. The goal isn't to avoid volunteers. The goal is to make sure that your volunteers are properly accounted for in your risk management strategy. Mistake number 6, not reviewing special events coverage before they happen. Let's talk about fundraising events, galas, golf tournaments, auctions, community festivals, fun runs, charity concerts. All of these events are incredible opportunities to bring awareness to your organization and raise money. They're also one of the biggest areas where nonprofits accidentally cause new exposures. Here's what often happens. An organization plans a major event. They book the venue, they find sponsors, they recruit volunteers, and they market the event. And nobody actually checks whether or not their insurance actually covers the activities taking place. Sometimes the venue requires additional insured status. Sometimes alcohol is being served. Sometimes outside vendors are participating. Sometimes attendance is significantly larger than normal operations. The worst time to discover an insurance-related issue is after an event-related claim. Before every major fundraiser or community event, take a few minutes to review it with your insurance advisor. A simple conversation can prevent a lot of headaches later. Mistake number 7, never conducting an annual coverage review. This may be the most common mistake of the entire list. Nothing stays the same, especially in a nonprofit. Your programs evolve, your staff grows, your volunteer base changes. You acquire new equipment, you launch new initiatives, you open new locations, you partner with organizations. Yet, many nonprofits have the exact same insurance coverage they did when they first started. Insurance just isn't something that you set and forget. It should evolve as your organization evolves. An annual review is going to help identify coverage gaps before they become claims. It gives you an opportunity to update property values, review cyber exposures, discuss employment-related risks, evaluate volunteer activities, and make sure that your policies still align with your mission. Think of this as an annual checkup for your organization. The goal here isn't to buy more insurance. The goal is to make sure that the policies that you have in place match the risk you face today. If there's one thing that I want you to take away from this video, it's this. The biggest insurance problems that face nonprofits today is the ones that they don't even know exists. Most claims don't start with bad intentions. They start with bad assumptions. We thought we were covered. We assumed the policy would handle this. We never realized that this was excluded. And by the time those questions are being asked, it's already too late. The good news, most of these issues can be addressed and identified before a claim happens. That's why we've created a free nonprofit insurance checklist. It walks you through key coverages, common gaps that we see, and important questions that every nonprofit should be asking. If you'd like a copy, click the link below and download it today. And if you'd like a second set of eyes on your insurance program, Leal Insurance Services is here to help. And more importantly, thank you so much for the work you're doing to serve your communities.